Hello and welcome to BloombergQuint. We got the first quarter GDP data today. On a year-on-year basis, the increase is 20.1%, obviously on a very low base of a quarter in which economic activity had come to a near standstill. That was during the first wave. Sequentially, between Q4 and Q1, there is a drop in activity, and that comes as a recovering economy was hit by a second wave of infections. So this is a number which is very difficult to try and understand and glean takeaways from. So we will bring in the experts to help us do that. We've got Kaushik Das, Chief Economist at Deutsche Bank, joining us, and Aurodeep Nandi of Nomura joining us. So we are sorted in terms of analysis over the next half hour. Thank you so much, both of you, for joining us here on this conversation. Kaushik, to you first. Year-on-year, sequential, seasonally adjusted. Firstly, tell us which of those numbers you're looking at and what that's telling you.
Hi, Ira. Thanks for inviting me. There are different ways to look at this GDP number, and you should look at it in a number of ways, not just by the way of year-on-year growth. We knew that year-on-year growth will be high, so it came at 20.1, which was almost close to the Bloomberg consensus estimate of 21%. RBI, I think, was at 21.4%. So no surprises over there. And given what we have seen, the severity of the COVID second wave in April, June, I must say that this number is actually impressive. If you remember that RBI in the June policy had revised their growth forecast for April, June down to 18.5. And they finally then again increased it to 21.4. So 20.1 in that perspective, given the severity of the second COVID-19 wave, is not a bad number. That's the first point. The second point is that on a sequential basis, quarter on quarter, there are different ways to again do seasonal adjustment, and sometimes I must caution that seasonal adjustment may also not make sense when you have this kind of a seismic shock in April, June 20 and April, June 21. But we are getting a number, for example, January, March was up about 2% quarter on quarter from October, December. This is all seasonally adjusted data. April, June, it's down about 1.2% from that 2%. So overall, there has been a drag of 3% or 3.2% quarter on quarter in seasonally adjusted terms. So that's the right way to think about how the growth has kind of slowed down from January, March onwards because of the second wave. If you did not have that, a sequential slowdown, obviously the year-on-year growth rate could have been much higher at maybe 25 or 30%, because we had a minus 24.4 in the previous year's same quarter.
Aurodeep, same question to you. What's your pick of ways in which to analyze the headline number first?
Well, again, I think this is one of those prints where sequential momentum makes much better sense in terms of figuring out what's really happening. And that's primarily because every number would look excellent and bombastic given the negative piece. Now, overall, I mean, again, as Kaushik mentioned, there are many paths to sequential seasonal adjustments. So, our estimates could differ there. But I think just taking a step back, the kind of key thing that we get out of this, right, without being too technical, is that, yes, we were anticipating some slowdown that was going to come from the second wave. But, the quantum of fall during the second wave is roughly 1/3 of the quantum of fall that happened during the first wave. If you take the sequential momentum and just compare it, that's how it's coming across. Now, part of this story was on expected lines. So agriculture growth being robust, expected. Industrial growth being strong, again, expected. The sequential loss in industry has been a fraction of what had happened during the first wave. What really surprised us, Ira, is actually what happened on services, right? Now, the hypothesis with which we entered this data release is that, yes, we've had lockdowns, but these lockdowns have been more lenient, have been more focused towards the contact-intensive sectors, and as a result of which, we've developed a sense of economic pandemic resilience, so to speak, over the course of this 1 year. So, hey, if your sector is not locked down, you're going to do okay. And I think what's sort of really surprising is the kind of broad-based slowdown which we've observed in the services sector. right? So the contact-intensive trade, hotel, transport, communication, they've been down by around 19% Q on Q seasonally adjusted. We've had construction down by minus 15%. But what's really interesting is that even beyond that, financial services, professional services, public administration have come down quite sharply. And I guess that's where the sort of negative surprise is. But again, overall, if you step even further back, the broad narrative that it's been a light touch hit to the economy broadly stands with this data release.
Okay, and I'll get back to the sort of the sectoral numbers in a bit, but Kaushik, that is one interesting way to look at it, right? So what one would have anticipated in terms of a hit as we went into the second wave versus what we got is probably reflective not just of the nature of the lockdowns, but also, as Aurodeep was saying, an ability to sort of function within those lockdowns. And I think globally it has been seen, for instance, there was an OECD chart which was showing that the correlation between mobility and GDP implications in any second wave is far lesser world over, and it's probably been the same in India as well.
Yeah, so clearly there has been a learning experience from April, June 20, and in April, June 20, when we had a national lockdown, it just it was you couldn't even know how to respond, right? And since then we have kind of got ready. In the next 12 months, the corporate sector has got ready how to deal with this COVID. So definitely, certain part of that learning experience has helped. But the nature of lockdown also has made a big difference. And that is also a part of the learning process, that should you lock down the entire economy for 3 months? And remember that each state would have a different starting point for the COVID wave. So Maharashtra had it first, then some other states started contracting. So how do you keep all the states locked at the same time when, maybe Maharashtra is coming out of it? Should you keep it locked even then? So I think it was a kind of wise move to keep it like localized and let each state decide how much or which particular containment zone they want to do. And that, coupled with the fact that corporates have learned to live with COVID, all of us have learned to order through Zomato and Swiggy for an extended period of time. So that way it hasn't hurt much. And what Aurodeep said, I think when in April, May, the COVID numbers were going up, the economist community and the analyst community, I think, became too pessimistic and felt like, you're going to have a very, very bad number. And you can see that in the subsequent revisions that happened from March onwards till May, June. And then when the actual numbers started coming out in April, May, June, even on a sequential basis, when you started kind of analyzing, you found out that, okay, growth is obviously, hurt, but not as bad as we had thought. And, the bearish people could argue that this GDP probably doesn't capture the entire impact on the informal sector. And, those realities are there. But as far as data that is concerned that we use as analysts to, kind of figure out the momentum, it has been better than what people would have thought 2 months before, I would say.
Fair enough. And I know you were steadfast in your annual numbers, but we'll get to that in a minute. Let me just get down to the breakups now. Aurodeep, on the expenditure trends, I think when the Q4 data came, one takeaway was that the rebound in consumption was slower than, say, the rebound on the investment side. Now, again, I don't know what to understand of this Q1 number because the base was also very different in terms of the fall in investment and the fall in consumption last year, same time, and hence obviously the level of rebound will be different. Is there any way to understand what to take away on consumption activity in particular from this number?
Yeah, so Ira, the way I have looked at all these numbers is really to not look at the year-on-year numbers.
Okay, so you're doing seasonally adjusted quarter-on-quarter, or
yes,
okay.
Exactly.
Okay. So help us understand vis-a-vis that.
Right. So by that metric, consumption has been hit by close to 7% by our estimates, Q on Q seasonally adjusted. Again, I mean, this is a.
And what was the growth in Q4?
In Q4, we had around 3.4%.
Okay, so a significant
3.4%. Yeah. 3.4%, and I think let me revise. It's minus 8.9 by my estimate now. So there's been a fall.
Okay.
But this compares to minus 22% in the first wave. This minus 8%, minus 22%. Similarly for so that's consumption, and I think that was largely on expected lines because as you said, consumption had this very rocky kind of ascent. There was this this whole festive Q4 thing, Q3 FY21, and then it sort of stabilized in the last quarter, and then the second wave has hit it. I think on the demand side, the surprise has been on fixed investment, right? Now, by our estimates, fixed investment has gone down by over minus 15% versus, again, minus 39% in the first wave, right? But even minus 15% sequentially lower, it's surprising, right? Because, one, the lockdowns were not aimed at investment activity. Two, you would have imagined that public capex, the focus has been there, so there should be some degree of support from there. So again, that's sort of been the surprise, not as much the consumption fall. In terms of government spending, also retracted pretty sharply. This is the revenue spending in this quarter. The export-import side, it's interesting, right? Now, you have a blockbuster year for global growth. So exports are up. Even sequentially, they're up by over 7%, right? Versus around 8.8% last quarter, which is pretty huge, which is very good. And imports are lower. So imports are minus 3%, seasonally adjusted, versus around 17% last quarter. And that's okay. That makes sense because, if your growth is weak, your imports are likely to be weak. But, on a year-on-year basis, imports fell further in the last year than exports. So the net contribution, and this is getting irritatingly technical, but
no, it's fabulous. Please go on.
But the net contribution from exports, net exports, it's still a drag on GDP. So, to sum up on the demand side, consumption hit, which is expected. Investment hit, which took us by surprise. Government spending hit. Exports doing well. Imports have retracted. So that's sort of how I would look at it.
Okay. Kaushik, do you agree?
So, yeah. So the way to think of it is, from my point of view, what are the factors when I was forecasting the number for April, June, what has that surprise on the upside or downside? And for me, the surprise that I've got, not actually surprise, but the extent of the fall is government consumption expenditure. So government consumption expenditure is down minus 4.8 on a year-on-year basis. And that was 12.7% year-on-year up in the previous April, June 20. Now, if you look at the nominal expenditure, government consumption expenditure, that's up 2% year-on-year, but the deflator is 6.8%. So therefore, you have got a real government consumption expenditure minus 4.8 because your inflation is more than the actual nominal expenditure. So if you look at the April-June fiscal spending of the government, total expenditure was up 0.7% year-on-year. You must be remembering when you summed up the April-June fiscal data, we got like 0.7% year-on-year total expenditure. So this was expected, but I did not expect it to be minus 4.8. And that is where the problem is. We've got the July fiscal data. And if you look at the July fiscal spending year-on-year compared to last year, it's down again 23% year-on-year. Yeah. And we don't know what has happened in August. So the point is, in July, September GDP growth, when I do the forecasting, what do I take as the government consumption expenditure, which is mostly a function of the fiscal spending? Now, ideally, the government should be spending a little bit more to support growth. And, private investment, you don't have a complete control. It's up to the corporate sector when they want to invest or when they're ready to invest, when uncertainty comes down. But the government should be kind of front-loading growth. Now, that can come about in the second half of FY22. It's not that the government is planning to cut expenditure and reduce fiscal deficit. But as of now, we still do not have that support from the government consumption expenditure point of view. And that's why, growth is maybe 20.1. It could have been 22% if you had more support from the government sector in this particular quarter. And what Aurodeep talked about, exports, imports, if you just look at the net contribution of net exports to growth, that is down minus 3.7%. That is expected because your investment side is up 55% year-on-year. So imports growth has been higher than the exports growth just on a year-on-year basis. And that was a huge kind of surplus, if you remember, in April, June of 20, when we moved into a current account surplus. So, so those kind of dynamics are playing out. Now the question is, the more important question I'm sure you'll ask is, what will sustain this momentum that we are seeing? I mean, obviously we have had a negative sequential.
I'll get to that in a minute. But your basic point is that government was a drag in this quarter more than anything.
Relative to all the things that you can think of. In fact, agriculture sector growth at 4.5% is pretty impressive, coming on the back of 3.5%. So all the other areas are fine, but the government consumption expenditure, in my view, is the biggest disappointment in the whole GDP data.
Okay, understood. On the industry trend side, on manufacturing, agriculture, I think you already mentioned already, but feel free if you want to add anything there. Should we make anything of the manufacturing number? Again, it's very high on a year-on-year basis. I don't know what the seasonally adjusted numbers, according to you, look like.
So the seasonally adjusted number, so you shouldn't be worried about manufacturing. Seasonally adjusted numbers, the rough calculations we are getting is around minus 1.7%.
Okay.
This compares to around minus 30.5%.
Much lower.
Much lower, right? And so overall, industry is fine. And as Kaushik mentioned, agriculture at around 4.5% is obviously a surprise. I think the biggest negative surprise is services, right? So services overall, it's around minus 12% versus minus 23%. In sequential momentum terms. So you can, to get a flavor of this, overall the sequential momentum of say GDP is just 1/3 of what it was last in Q2. But as far as services is concerned, it's half of what it was in during the first wave. So to reiterate,
say that again.
Yeah. So the contraction that took place in the first wave, overall as a basket of goods, services, etc., GDP, it's been roughly 1/3.
Okay.
Right? But in the case of services, it's been half.
Okay, understood.
Right. So the drop has been more significant. And as I mentioned at the very beginning, you've seen a lot of drag come across in trade, hotel, transport, communication, close to minus 20% versus minus 43% then. And that is understandable because, you've had lockdowns and you've had restricted timings and people not getting out. So that's understandable. Construction is also down by around minus 15% sequential momentum. But what's really surprising is again your financial services, professional services. There shouldn't be a reason why it's sequentially contracting by 4%. Whereas, in fact, in the last in the first wave, it contracted by around 3.5%. So, in fact, the momentum has dropped quite significantly there. And also, and this goes down to the government spending side. The public administration side is down by around minus 9%, which is again pretty steep. So on the supply side, I think agriculture, great. Industry, it's a small dent, but where the accident has gotten gruesome is services, which has been hit on a really broad-based fashion.
Kaushik?
Yeah, so I'm just hearing Aurodeep talking about seasonal adjustment quarter on quarter, and I'm just thinking what will happen after a few quarters when all those numbers are revised in the previous year, whether the narrative will change and you'll see.
You folks should ask for a double bonus, yeah.
No, so I've been doing this for a long time, and you have to be. Even the CSO, if you look at the way they compile the numbers, at that point of time, they don't have all the numbers. So they would often try to put things under discrepancy. So I don't know, we didn't discuss the component called discrepancy. In this quarter also, discrepancy subtracted 70 basis points from growth. So if you were to add back, so 20.1 becomes 20.8. And in January, March, you remember that we had this problem with calculating subsidies, net transfers, because a lot of subsidies were given in the last quarter of January, March 21. So the entire subsidy, that component was taken as part of discrepancy. And therefore, you got a 1.7% GDP growth, whereas your GVA growth was 3.7% in January, March. So these numbers are subject to changes. And I will not read too much into all these seasonal adjustment details, because first of all, one is the numbers will change for sure. and then this whole narrative also may change. The second is that the other problem that we are facing, and this is a constant problem, that we don't have the breakup of investment between private and government on a quarterly basis. So all I can infer is from the fiscal spending or the amount of capital expenditure that has happened from the government side, but that data comes with a lag of 1 year on an annual basis, and then only you'll be able to figure out from the GDP data whether private investment is picking up or not. So these technical issues are there, but the broad point is growth is better than what people had kind of feared it to be for April, June. And therefore, going forward, I think RBI and most market participants will find it more comfortable to think about the outlook, given the shock that the economy has been able to withstand and the resiliency with which India has managed to move on despite the severity of the second wave.
Okay, let me just get to those points as the last sort of round of conversation, more qualitative than quantitative. Aurodeep, what are you thinking the current quarter will sort of look like? Having seen already that mobility indicators, for instance, have a looser connection with what actually happens in terms of output, given what we've seen in the Q1 numbers. We've seen a sharp rebound in some of these, concurrent indicators, many of which are based very heavily, or at least reasonably heavily, on mobility. So if one uses what we have there, such as your business resumption index, plus draws from the current quarter numbers, what do you think Q2 looks like, and what are your annual numbers now looking like?
Right. So in terms of so I think one way to look at it is just to kind of chart out in the air how the trajectory has been going month on month, right? So you had April, which was relatively stable despite the second wave. Then you had a small but sharp fall in May because of the second wave. And then in June, you saw a rapid rise. In some sectors, it almost reached back to pre-second wave levels. In others, it's been still lower. And what we've seen is in July, it's kind of plateaued, right? So there's been a sense of fatigue that we've seen, especially in consumption, and especially in the external sector, in the non-oil import side. We've seen some degree of easing. Now again, these are not based on just year-on-year numbers. This is, we do a Nomura normalization index that kind of normalizes it to pre-pandemic levels. And I think what we are so the July data seems to suggest that there's some plateauing after a rapid rise. But through in the case of industry, in the case of services, it's still improving, right? The August, and you mentioned the Nomura India Business Assumption Index. Now for August, we really don't have too much of this conventional monthly data to talk of, right? So we are now in the realm of ultra high frequency data. And what's this ultra high frequency data telling us? Well, that the momentum is pretty much there in August. So in August, our business assumption index, the Nomura India Business Assumption Index, has crossed pre-pandemic levels, right? So for the first time, and for the past 3 weeks, it's been above those pre-pandemic levels. And yes, part of it is because of better mobility. And again, you're absolutely right that the correlation of mobility with growth reduces as you go forward in terms of pandemic waves. But hey, the other indicators have also shown that overall the economy remains in a constructive mode. It is recovering. Now, the key risk, the way I see it, is a third wave, right? That's sort of the big elephant in the room, and no one knows what's going to happen. The way to insulate yourself from a third wave is a vaccination. So currently, in fact, the next couple of quarters, it's not a deep intellectual debate. It's all these cyclical factors that you're talking of, right? If, for instance, you keep your vaccination pace to say over 7 million doses a day, right? If you manage to get that momentum rolling, and you manage to get, say, half of the population vaccinated by the end of the year, you do have a vaccine pivot, so to speak, in the sense that you will have sectors that have still been in a relative lock situation unlock. So, the RBI keeps saying, look, capacity utilization is low. Well, one of the reasons it's low is because, we've really not reached to pre-pandemic conditions of operation. And that happens once you have the vaccine pivot. The other thing is that over the coming quarters, you will have the festive season kick in. You'll have the arrears come in from of dearness allowance, right, which have been sort of in the pipeline for such a long time, and it'll sort of come in the form of arrears. Plus, you've got easy financial conditions, so interest-sensitive sectors should do reasonably well. And then, this is a blockbuster year for global growth. There's a party going outside. So typically, India's growth cycle is linked pretty closely to the global growth one. So, I mean, you put all these factors together and add to that the general fiscal activism towards capex. I think we are decently optimistic in terms of the growth recovery sort of continuing across the next few quarters.
We lost the connection there for a minute. I think Aurodeep had more or less sort of concluded his answer. I think if we still have Kaushik, let me just throw that one last question to you, which is the big question as to whether the data we have plus what we're seeing in the July to September quarter will give enough comfort to the Reserve Bank of India and the MPC to start moving along their normalization path.
I think Aurodeep mentioned a couple of points why growth trajectory should be moving, in the right direction, and I agree with him. And remember that last year, July, September, we were down minus 7.3%. So the base is still positive. So I think we can get a 7.5%, 8% positive growth in July, September. If you look at the core infrastructure production data, which came out today, July was about 9.4%. So, things are looking good as far as the future growth trajectory is concerned. Third wave of COVID is obviously a risk. We'll only get to know in the coming months and when the festival season is over, whether cases are increasing or not. As of now, 70% of the cases are being contributed by Kerala, so it's not broad-based. So if you can take care of Kerala, I think India's numbers will look pretty good. And the vaccination doses have increased quite significantly in the last 1 week. If you can maintain that momentum, all that will, give a lot of, kind of positive kind of feeling to the whole corporate sector, and they can feel more comfortable to start investing. There are a couple of risk factors which I want to mention. One is obviously the big story about China slowing down. And we know that, there are big, trade linkages with China. Nowadays, it's not just US and Europe. So we need to also kind of keep in mind whether exports growth, the kind of growth that we have seen in the last few months, whether that momentum will sustain or not. And as China slows down, whether the global economy slows down to some extent. It's not that the level of growth will fall significantly, but the sequential momentum can slow down in the next few quarters. So that's something we need to keep in mind. Agriculture growth has been good so far, but the rainfall has been a bit patchy. So that's more of a risk on inflation than growth. To your question about RBI, I think, the growth numbers that we got today and the trajectory that we are going forward, I think it doesn't make any change to RBI's plan of normalization. In our view, output gap only closes by the end of this fiscal year. So therefore, I think the next step that RBI will look for is taking care of the huge amount of surplus liquidity that we have. And the only option that I can think of is increasing the longer tenor VRRs, more than 14-day, moving to 28-day or 56-day of INR 2 trillion and sucking out liquidity over a longer period of time, but while keeping the stance still accommodative and only changing it probably in February of next year. But we expect a reverse repo rate hike in December of 20 basis points, followed by another 20 basis points in February. But the stance from accommodative to neutral, we expect it to change only in February of next year.
Okay, I'll leave it at that. Kaushik and Aurodeep, thank you both so much for joining us. Apologies for that small technical glitch towards the end. But thanks for that discussion. It'll be up on BloombergQuint.com shortly as well. Thanks for watching.
Thank you, Ira.